What if I told you that your first $100 could spark a real change in how you think about money? If you treat it as a learning tool instead of a purchase, that 100 can grow into a long-lasting habit that earns you money through your own choices. In the next few minutes, I'll share a simple, actionable plan you can start with today and grow, month by month, no magic needed. This isn't about getting rich quick or chasing hot tips. It's about building a tiny, repeatable system that fits in with an ordinary life, even when surprises pop up. We'll break it into three parts: a small core portfolio you can grow, a steady monthly habit, and a simple way to check progress so you stay on track. First, you need a clear goal and a sense of risk you're comfortable with. Ask yourself how long you want this money to work for you, what you'd do if markets swing, and how much you'd be willing to lose without losing your nerve. With that honest picture, your $100 becomes a compass rather than a shot in the dark. Second, design a tiny core portfolio that is easy to repeat and resilient. The idea is to own a mix that mirrors the broad market with enough balance to damp swings, mostly stocks, some international exposure, and a little ballast in bonds or bond-like assets. Even though you start with $100, you can own 4 or 5 fractions that fit your plan, so you're not forced to buy a whole expensive fund. A practical starting mix could be roughly 60% in a broad U.S. stock market fund, 20% in an international stock fund, and 20% in a bond fund that acts as a cushion. This blend gives you growth potential, global exposure, and a safety margin when volatility spikes, which often helps new investors stay calm. You don't need fancy or risky bets to begin. You just need a simple structure and low costs that keep compounding true. Because you're dealing with fractions, you're not forced to put all your eggs in one basket on day one. For example, with a $100 budget, you might place roughly $60 into a U.S. stock fund, $20 into an international fund, and $20 into a bond fund using fractional shares. If you want a little extra flexibility, you can swap one piece for a dividend-focused fund or a cash-like instrument that you can access if you need a quick emergency. Third, automate what you can, so this becomes a habit that runs on autopilot. Set up a recurring purchase every month, even if it's a small amount like $20, and schedule it on the same day you get paid. Automation turns investing into a routine you hardly notice until you look back and realize how far you've come. Fourth, plan a quarterly rebalance so the original weights stay close to your targets. Because markets drift, the dollar value of each piece will diverge. Rebalancing means you buy what has lagged and sell a bit of what has led. You don't need to rebalance every week. A predictable schedule, like every 3 months, keeps the plan sane. Fifth, keep costs low and focus on simple, enduring investments. Choose low-cost index funds or ETFs rather than trying to beat the market with expensive products or frequent trading. The right costs are invisible until you see your results years later, so protect your future by avoiding avoidable fees. Sixth, build a small money routine around your investing plan. Maintain a tiny notebook or a digital note where you log what you saved, what you bought, and how you felt during the month. Review this log regularly, celebrate progress, and let the plan evolve with your life instead of staying fixed to a date that may never arrive. Now let me sketch a concrete example that makes this tangible. Imagine Mia starts with $100, allocates 60 to a U.S. stock fund, 20 to an international fund, and 20 to a bond fund, and then adds $20 every month. If the market returns 6% annually and fees total 0.2%, Maya's balance grows gradually over a few years, and the habit compounds into something meaningful that she can trust. If you're listening for the first time, this may sound surprisingly doable. The beauty of the plan is that you don't wait for perfect conditions to begin. You start with what you have and you keep showing up. The money you want to build starts with a simple, honest first step that you repeat again and again. A word about risk. You can experience losses, especially in the short run, and that can feel uncomfortable. Investing is not a shield against uncertainty, but over the long run, patient, steady investing tends to reward those who stay the course. If your life changes or you feel unsure, come back to your goal, adjust the plan, and keep moving rather than stopping. If you want more structure, you can think of this as the $100 core that grows with you. When you have more money, you can scale the same weights or add more funds to broaden diversification while keeping costs tiny. The key is simplicity and repetition because those two things unlock real progress without requiring permission or luck. If you found this helpful, hit like to tell me you want more videos about starting small and growing with discipline. Subscribe so you don't miss the next practical breakdown, and share a comment with $1 you could start with this month. Tell me what part of this plan you want me to dive deeper into, and I'll tailor future videos to answer your real questions.